Ladies and gentlemen, welcome to a new episode of the Fintech Hunting Podcast. We have an incredible guest for you today. He's an industry thought leader. He's an insurance and financial services evangelist. He's a digital experience expert. Help me welcome to the show, Ross Diedrich, founder and CEO of Covered. Ross, welcome to the show.
Wow, what an intro, Michael. Thank you for that. Appreciate you having me. Excited to chat with you today. Thanks for
Well,
hosting.
it is great to have you. You have a wealth of knowledge and expertise. Tell my listeners if maybe they don't know you or they don't know a lot about cover. Tell them a little bit about your background and kind of how you got into this.
Sure. I'd say somewhat traditional in terms of an entrepreneurial experience. But before Covered, I worked on Wall Street. I was a market maker in fixed income and portfolio manager and traded fixed income bonds. So, kind of a Wall Street background, chartered financial analyst with some experience across private equity, venture capital, and came across technology early as a kid. I loved innovation and technology and tools, and I thought patents were really cool and kind of nerdy like that. So I wrote them in college and helped friends launch businesses and helped launch half a dozen startups, kind of moonlighting while I was doing Wall Street. And I found I really liked that going 0 to 1. It was a lot more fun than making markets. That was a great time. I'm grateful for that experience, but it was so much more fun building. And I came across kind of this personal experience in buying a house and needing insurance, and was surprised by the process and saw an opportunity and decided I had an itch I had to scratch, and I went all in to start Covered. So Covered, at its core, started out by that personal experience of you buy a house or an asset like a car, you need to have insurance to go with it. And Covered's North Star is to offer that insurance that people need at the moment they need it, conveniently through an integration, kind of an embedded experience, and personalize the offer, give them choice and transparency, but make it really easy by meeting them where they are when they need it and give them exactly what they need at the right time.
I love it. And you brought up a number of key points in there. So I'm going to dive into those in a second. But we're into 2025 now. It's already hard to believe. Mortgage market for last year, 2 years, again, kind of limping along. What are some of the things you see in the mortgage and the mortgage insurance market as we look forward to 2025 and beyond?
Yeah, I first I'll start off by saying I think everybody's been wrong constantly with their forecast here. So I'm going to do a giant caveat on anything I say that's forward looking. But it's an interesting time with a new administration coming in. We've had we saw the refi boom and the compression in the industry, some consolidation, and stabilizing of the industry broadly. And so, the way we look at 2025 here at Covered and what we're hearing from our industry partners is, maybe a little bit of what we have seen in 2024. Rates maybe staying higher for longer than people anticipated, but a really, really large backlog of
Right.
people who are in the money waiting for rates to come down. A really low amount of people who are in the money for a refi right now, but the time will come. And so I think everybody agrees that's going to be a boon when that day comes, but a little bit of TBD on when that actually happens. And I think that's where the slippery ice has been, and trying to predict when that time will come. So
Exactly. And a lot of people who predicted it would happen in early 2024 and then the second quarter. So I agree with you. And we're not looking for that. We're really looking for, okay, what is the tone? What are people investing in? Where are they spending their time? So I think you give some great insights there. And let's talk about P&C insurance challenges and some of the market trends you're seeing from that perspective.
Yeah, I think there's a really interesting intersection there with the property casualty market, home insurance, the mortgage industry. And from our perspective, what has been really interesting over the last 12 months or so has been the focus on insurance. I was at a industry event with some of the chairmen and executives from the most prominent mortgage companies out there, and a little private event this summer, and I was shocked for the first time ever. I've been going to these for years. For the first time ever, insurance was one of the headline topics for a panel. And that has never happened. And like here I am in the crowd, kind of doing a cartwheel, like finally insurance has its time on stage here. But unfortunately, it's not because of good dynamics, right? It's been a really challenging market. There have been just really, really big changes in the actuarial models in underwriting. And we've had a lot of climate issues over the last 5 years, a lot of catastrophic losses that were hard to predict and kind of weather related. And so between fires and floods and some of the hurricanes that we've seen in increasing frequency, it's been hard to turn a profit in the property casualty market. Now, auto is turning faster into profitability, and we're seeing that with the rate filings and the amount of premium increases in the new carrier filings with the states are slowing down faster in auto than they are with home.
Okay.
So it seems like the insurance carriers on auto are stabilizing faster, which is great.
Right.
Hopefully that's kind of precipitates the same in home, but home, it has this weather catastrophic loss dynamic that auto does not. Auto is just a law of large numbers. Yeah, home is far more random occurrence of catastrophic loss. So we're hoping we're turning the corner here in the next 12 to 18 months, and we're seeing some signals there. Like I mentioned with auto, what we pay attention to, I covered, are the carrier filings with the states, and they publish these every month. We track them, and the premium increases year over year have ranged from high single to low double digit, kind of average across the board. Some carriers, renewal increases have been 25, 30 plus percent. Some of the big prominent carriers have been 20 plus percent increases year over year for a couple of years straight. And that's a problem. It's a problem for the mortgage industry and the borrower, the homeowner. It's what needs to happen for the carrier side for profitability. And until carriers can achieve some profitability in underwriting, and we'll continue to see it. But right now, for the most part, most home carriers are not profitable. Some are, and they're niche and focused and disciplined in their business, but it's a big business and it takes time to steer that tanker back to profitability and adjust and work through all the regulatory dynamics. So all that said, we're seeing the percent increase filings decrease in the amount of the increase.
Okay.
And so, for example, last month, instead of seeing 18% kind of on average for the filings for the rate increases, it's now closer to 10. So it's a good signal that we're getting closer to underwriting profitability in the industry, but we're not quite there. And so I think if you play that forward as they hit these rate increases for another cycle here over the next 12 months, I think we could see ourselves in a position maybe end of 25 into 2026 where rates are stabilized in home insurance and perhaps even starting to come back. And that's the last thing I'll say is, there's a lot of increase across the board. Eventually it will stabilize. And eventually those carriers that have achieved profitability, they're going to want to grow again. And that day is going to come. and the rate cuts on premium will follow. So it's kind of a hang in there, do whatever you can, make sure you have coverage, and wait it out. And we think we'll see the golden days in PNC in 2 years or so. But the intersection there with mortgages is really challenging. And so back to what we're seeing with the challenges there for the mortgage industry is, you know, going back to that panel this summer, the affordability of insurance is impacting debt to income ratios, the ability to buy homes. And so on the origination side, it's really screwing up the equation. And now it's a surprise. And we're even hearing from originators and loan officers that it's becoming a reason why they don't close a loan. And that is a huge problem.
And let's start diving into that. You shared so many wonderful insights there. And I think as we look for the market to start stabilizing, what I'm seeing, and you're saying, okay, it's now becoming a problem for origination. It's becoming a problem even for servicers. How then should these lenders start investing in insurance technology? Why is embedded insurance providers gaining more and more traction?
I think first and foremost, historically, insurance was an afterthought. You would stub a number to close a loan and, figure it out. But now it's legitimately more of a question of, can this house even be insured before you get too far? So what we're encouraging our partners to do and how we're kind of positioning for home insurance in the market right now is get in early. And there are ways that you can check for the ability to cover a home as you're looking at various properties. If you're a buyer and you're looking at 3 homes, it's not always extremely easy to determine if there has been a claim or if it's in a low grade flood zone. And so what we're encouraging loan officers and originators to do is, if you have a borrower that's looking at a couple of finalists to put an offer, run a quote. Run a quote with us, do it early, or whoever, and make sure you can insure the house and the borrower still fits in the box for DTI. And then second, move home insurance earlier. Once you have an offer accepted, it's one of the first things you should look at. And we're seeing loan fallout there, so get ahead of it. And it's really helpful to have a marketplace. So adopt some technology that allows you to take an early look at insurance on properties even before you put in an offer. Make sure you can insure it, and then move quickly into searching the market and finding the best execution you can for that home. And marketplaces like Covered are the best place to go to make sure you've got breadth of offering of national carriers, regional carriers, because oftentimes, and it's going to be the regional carrier right now that's going to have the most competitive pricing.
Now let's shift gears a little from the origination side to the servicing side, because as you talked about, there's a lot of market dynamics and there's a lot of changes going on. So how does that servicer check their portfolio to make sure that people are insured, to make sure that they're not underinsured? And walk me through that a little bit.
Well, right now, the short answer to that is they're not really paying too much attention to that, unfortunately. Or they haven't been and they now are, rather. So there are a few things going on there that servicers need to watch out for. And there's some motion in the GSE requirements around coverage amounts, replacement costs, things like that. So you have to, our partners in servicing are looking to us to help make sure that adequate coverage is in place. So I think thing number one from an operation standpoint for servicer is coverage adequacy. And so that's a really easy thing for us to do. And it's kind of tracked, kind of not tracked by traditional insurance trackers, but the umbrella of underinsured homes is a lot larger than you would think, and is kind of ugly. So that's thing number one that they're now paying more attention to and need to keep an eye out for. But I think what we're seeing right now and really focused on is affordability for servicers, right? You've got borrowers who got their dream home. They're in a 30-year fix. They think they're going to have a flat payment because it's a 30-year fixed, but reality kicks in and their escrow review comes up, and lo and behold, their monthly mortgage payment went up by 15, 20%. And they're calling the servicer, thinking the servicer screwed up and it's their fault, and they're not sure what's going on or why. And there's this underlying issue with insurance that's causing confusion and complexity and operational drain and cost. And our partners are citing that, my payment went up is the number one call that they get into the call center right now. So thinking differently about how home insurance intersects with mortgage servicing, I think is critical right now. So kind of thinking outside of the box around operationally, what is the impact of the business? And from a borrower in the portfolio standpoint, what's happening? You can combine those things to create a better experience, a less negative
Okay.
experience, I
Yep.
guess. Like
Right.
servicers are notorious for having terrible NPSs, and it's not really their fault. It's just the perception of everything is their fault. And so I think there's a really, really strong opportunity to improve operations and become a customer advocate right now by focusing on affordability of insurance and helping these borrowers see, you don't have to keep that policy, you can switch it, and really making it easy for these borrowers to understand their options, quickly and easily switch coverage, or even demystify what is happening with their payment. And we see we are doing some really interesting things there with our partners around escrow and demystifying that and really minimizing the amount of operational costs that comes from those calls. And then the last one I have to note is we have seen quite a large increase across the board in the industry with the placement of LPI.
Okay. Yep.
And that's like one of the worst customer experiences you could possibly have, right? Like all of a sudden, your mortgage
That was
payment sky,
forced upon you. Yep.
it's 4x plus the cost. And oftentimes in the past, it was something happened administratively and proof of insurance just wasn't procured. And then, it was actually historically low single digits that were actually needed to be placed in LPI, right?
Right.
And that's just a really negative experience that should be avoided. And unfortunately, it wasn't. But now there's a legitimate need for LPI, and we're seeing people just go with it because they think they have no option because their
Option.
carrier dropped them. Uh,
Exactly. And I think you guys are doing some incredible things on the servicing end. I know you're going to have a strong presence at the MBA Servicing Conference coming up first week of February. So for those of you listening, make sure if you're going to be at servicing, stop, talk to the group at Covered. Make sure you schedule time with them because they're really doing some innovative things that can have a profound impact. Ross, we've only got a couple more minutes, and I still want to touch upon you guys made a big announcement last year at MBA Annual. Talk to me about the blend relationship and that partnership that you have.
yeah, it's a really exciting partnership, and the timing worked out perfectly with MBA Annual. We've really tripled down in the mortgage industry. We've got really exciting things coming out, servicing. Love to chat about that. If you're there, find me. We'll talk about it. But on the origination side with Blend, it was a long time in the making, I would say, and the relationship I have with Nima, they're a great company. We've been integrated with and have overlapping clients. We had a top 10 bank shared client that we had live with them, and the deal just made sense and was highly accretive for all parties and for Blend and for the direction they're going. It made a ton of sense for them to kind of divest and find an operator to take the insurance business and grow it. And for us, it's very core to our business model, and a major growth opportunity and accelerant for us. And then for Blend and Blend's lender clients, I think it's really exciting because the transaction allows for Blend's lender clients to have access to a lot more carriers for their borrowers. So the borrowers have way more options now than they did before. And they have more products that they have access to with Covered than they did before with Flood, Umbrella, and other things. And then Covered has the ability to cross into servicing and integrate into digital banking and automotive divisions. And so for those Blend lenders who have other divisions like servicing, now the value add of insurance and an integration of insurance within Blend can be taken outside of just the transactional point of sale moment in time. And those lender clients can add more value across their business with insurance with Covered now. So we're starting to work with some of those clients to say, hey, this is going really well transactionally in the point of sale. Let's go add more value outside of that in servicing or automotive. So it's a win-win-win for everybody from Blend to Covered, the lender clients Blend has to the borrowers.
I love it. Ross, you are a wealth of knowledge and expertise. You are welcome back anytime. I can't thank you enough for being a guest on this episode of the Fintech Hunting Podcast.
Thanks for having me, Michael. Appreciate you.